In this video, we'll learn about subsequent measurement of intangible asset. An intangible asset can either be recorded at cost model or the revaluation model. We shall start our discussion with the cost model, and that is where we initially recognize an intangible asset at cost. Well, after that cost has been determined, we subsequently deduct from it accumulated amortization and accumulated impairment losses, and that forms our carrying value, and that is the value that is represented in our balance sheet at the end of every year. And change between the carrying values each year can either be an amortization during the period or an impairment loss during the period, and both of these deductions or changes are represented in the profit or loss account, and they represent the usage or consumption of the asset or reduction in value of the asset. Let us look a bit deeper into amortization. Now, if I want to amortize an intangible asset, I need to know its cost, obviously, but I also need to know two more things. I need to know the amortization period and the amortization method. So first, let's break down the amortization period, and we need to determine basically when the amortization would begin, how long would the period be, and when that amortization would cease. So, for example, if I purchased an intangible asset on December 2019 and that intangible asset was available for use on December 2020, and I actually started using it on December 2021, when should the amortization period commence? Well, according to the standard, amortization shall begin when the asset is available for use, and by available for use we mean that it should be in the condition intended by the management for use. Now, if that asset's life is 5 years, that's what we call the useful life. If the useful life is 5 years, we shall start counting those 5 years from 2020, which means the useful life ends in 2025. And if the amortization method is straight line, we would expect to depreciate or amortize it 20% every year. However, if that intangible asset is held for sale 1 year prior to its derecognition, now should we continue to amortize it in the last year as well? And that is when the standard says that amortization shall cease at the earlier of when the asset is derecognized or the asset is held for sale. So we now have a good idea of when to start amortization, when to stop it, and how long should the period be. Now let's come to the amortization method. And the standard says that the amortization method should reflect the pattern of usage of that intangible asset. For example, if I expect to consume 50% of that intangible asset in the first year, 20% in the second year, and 5% in each of the next 3 years, and then that should be my amortization pattern. However, if I cannot reliably determine the pattern of usage of any asset, in that case I would have to use straight line method. Now, one more thing about pattern of usage is that the pattern of usage is a different thing from the pattern of revenue. And the standard says it would be presumed that revenue is an inappropriate basis for representing the pattern of usage. Another component of our amortization method would be the residual value. How much should be left at the end of that intangible asset? Well, according to the standard, the residual value shall be assumed to be 0. Now, why is that the case? In case of tangible assets, where we can actually scrap the machinery, we can sell its parts and scrap, we cannot do the same with intangible asset because there are almost never active markets for their purchase. And a residual value for intangible asset can be used if one of the two conditions are fulfilled. The first is that either there should be a commitment from a third party to purchase that asset at the end of its useful life, or the second condition is that there is an active market for the asset and the residual value can be determined by reference to that market, and it is probable that such a market will exist at the end of the asset's useful life. Which means there should either be an active market and it should be expected to be there at the end of the useful life, and the value can be determined by reference to that market. And if that market doesn't exist, then at least there should be someone's commitment to purchase that intangible asset at the end of its useful life. If none of those conditions are fulfilled, neither there is a commitment nor there is a market, in that case the residual value of that intangible asset should be assumed to be 0. Now, because intangible assets are slightly more volatile and their lives and patterns are slightly more ambiguous than tangible asset, the standard requires us to review the amortization period every year and review the amortization method every year and review the residual value every year. And because of the interesting peculiarity that the residual value is actually based on the market, it could possibly be true that the residual value might go above the carrying value. Which means if an asset has been purchased for $100 and it has been used for 3 years and it has been depreciated to $40, its residual value may jump up to $50. And if that is the case, the entity should immediately stop amortizing that asset until the asset is eventually derecognized or the residual value goes down again, because we are reviewing the residual value every year and that might go up and down based on the market. Now, all of these changes, may they be the change in amortization period, may be a change in amortization method, or may be a change in the residual value. Remember, residual value is not reflected on the balance sheet. It is an estimate which we actually use to compute the amortization. Therefore, all of these changes are actually basically a change in estimate. And whenever we change an estimate, we apply those changes prospectively in the future years. For example, if our original case was we purchased an asset for $100 and we amortize it on straight line basis for 5 years, that would be our pattern of consumption. However, if after the use of 3 years, the expected life of the asset was extended to 6 years, in that case, the remaining amortization would spread over the new useful life. Now let us go through a very interesting combined example of all of what we have studied. Let's say we purchase an asset for $120 at year 0 and we expect to use it for next 5 years and its expected residual value is $20. So can we compute the amount of amortization every year if the method of amortization is straight line? Yes, of course. It's simply the cost less residual value divided by the useful life, which is $120 minus $20 divided by 5 years, which is $20, which means we are expecting to amortize that asset by $20 every year. However, if at the end of the first year the intangible asset is impaired such that its carrying value falls to $60, which means that in the first year we incurred an expense of $20 as an amortization and $40 as an impairment loss. Now from there onwards, can we compute the amortization for the remaining useful life of the asset? Yes, we can. That we can do by subtracting the residual value from the carrying value, that is $60 minus $20, divided by the remaining useful life of the asset, which in this case now is 4 years. So 60 minus 20 is 40, and divided by 4 is $10, which means in the next 5 years, in the next 4 years, we expect to amortize that asset by $10 every year. Now, what if at the end of the 4th year, which means after we have amortized that asset for $30 more, and the carrying value then would be 60 minus 30 equals to $30, right? Now, at the end of the 4th year, if we expect that the useful life of the asset would be extended by 1 year, which means instead of ending at 5 years, it would now be ending at 6 years, which means that we would have to amortize the remaining value of that asset over next 2 years. So can we compute that amortization? Yes, we can. And that is 30 is the carrying value less the residual value, which is $20, divided by the remaining useful life, which is 2 years, and this gives us $5, right? Now, if at the end of the 5th year, if we realize that the residual value is now actually just $10, what do we do now? Well, which means that for the 6th year, we would have to update our estimate of the residual value. Now, if at the end of 6th year, we realize that our residual value is actually only $10, what do we do now? Just like we have been doing, we would be updating our estimate, which means that the carrying value at the starting of the 5th year was 30 minus 5, which is $25. And now we have to amortize it for 1 year. And therefore, the amortization would be the carrying value, which is $25, less the residual value, which is now $10, divided by the remaining useful life, which is now just 1 year, which means the amortization for the last year would be $15. So that's how we keep updating our amortization and the useful lives as a change in estimate, and we do it prospectively. Now, when an intangible asset arises because of a contractual or legal right, in that case, that right may even be renewable. And in that case, we have to think about what would be the useful life of that asset. What would be the amortization period in that case? For example, if an entity purchases a license from a government for 3 years, and if the entity expects that it would consume all of the benefit from that asset within 2 years, in that case, the standard says that the amortization period will be the shorter of the useful life and the contractual period of the asset. However, if that contract is renewable, in that case, that contractual period might include those renewal periods as well. For that, the intangible asset has to fulfill certain conditions. So we know that if the contract is non-renewable, we would only include one contractual period in our analysis. However, if that contract is renewable, for example, after the expiry of 3 years, it can be renewed to further 2 years and so on. In that case, we would have to see whether we have to include further renewal periods in our analysis or not. And there are two cases basically. First is whether that renewable contract can be renewed with significant cost or without significant cost. If that renewal requires significant cost, in that case, we would not include the renewal periods in our contractual period, and that would only include one period. However, if our contract is renewable without significant cost, in that case, we would have to see whether that asset has been reacquired in a business combination or not. If that asset has been reacquired in a business combination, in that case, that would not include the renewal periods, right? However, If it's an ordinary asset with an entity, then the contractual period will include the renewal periods. Now, what does it mean to be renewable without significant cost? When we say that a contract is renewable without significant cost, this means that that contract has to fulfill all of the following three conditions. The first condition is that there should be an evidence that that asset, that contractual or legal right, will be renewed. If there is no evidence, for example, based on past experience, that it will be renewed, in that case, it will not be included in our contractual term. The second condition is that there should be evidence that any conditions necessary for the renewal will be fulfilled. And if there are certain conditions that need to be fulfilled and there is no such evidence whether they would actually be fulfilled, in that case the renewal period will not be included in our contractual term. And lastly, obviously, the cost of the renewal to the entity should not be significant. And when we talk about being significant, it should not be significant as compared to the future economic benefits that are probable to flow to the entity. Now, in addition to the cost model, we can also carry our intangible assets on the revaluation model. And as the name suggests, revaluation model is where we have to carry our assets on its fair value, less accumulated impairment losses, and less accumulated amortization. Which means that frequently we have to revalue an asset to move its carrying value closer to its fair value. So first of all, which of the assets should be fair valued? Which of the assets can be actually accounted for on the revaluation model? So the standard says that those assets for which there is an active market and the fair value of the asset can be measured on the basis of that market, only those assets can be measured at fair value. Which means if there is no active market for an intangible asset, in that case, that intangible asset cannot be carried on the revaluation model. It will have to be carried on the cost model. Now, even if there is an active market, it's not compulsory on the entity to carry that asset on the revaluation model. Rather, it has a choice. And the choice is it could possibly carry it on cost model, but if it really wants it, it can also carry it on the revaluation model. But once an asset has been chosen to be carried at revaluation model, then all other assets in the same class would also have to be carried at the revaluation model. Now, what do we mean by the same class? A class of intangible asset is a grouping of assets of similar nature. For example, there could be a class of intangible asset with all the brand name that an entity has. A class may contain all the computer softwares of that entity. A class may contain all the licenses and franchises of that entity. Similarly, a class may contain all the copyrights, patents, and other industrial property rights that the entity holds. So, a class is a grouping of assets of similar nature. So, if one asset in that class is being fair valued, then that means all of the assets in that class will have to be fair valued. Now, there's an exception to it. If one or two or more assets in that class do not have an active market, in that case, they will have to be accounted for at cost model. Now, let us also be aware of the fact that it is very uncommon for an active market to exist for an intangible asset. But in some cases, it might be the case. For example, in some jurisdictions, an active market may exist for freely transferable taxi licenses, fishing licenses, or production quotas. So these are very rare cases, very specific cases, and it's not a common case. Now, once an asset has been chosen for the revaluation model, how frequently should we be revaluing it? First of all, we should be clear that the initial measurement has to be done at cost, just like in the cost model. And that we have discussed in previous videos, how to initially measure an intangible asset at cost. Now, once we have initially measured it at cost, from there onwards, we have to start our process. So, how frequently? Well, the standard says that revaluation shall be made with such regularity that at the end of the reporting period, the carrying amount of the asset does not differ materially from its fair value. Which means whenever an entity reports its financial results, at the end of every reporting period, we have a carrying value, and that carrying value should not be materially different from its fair value. And if it is materially different from its fair value, then we will have to revalue it. So the frequency of revaluation depends on how volatile the price of that asset is. If that asset price changes very frequently, in that case we would have to revalue it every year. However, if the price of that asset is stable and doesn't change very much with time, in that case we can revalue it more sparsely, say 2 years later or 3 years later, depending on the volatility of that asset. If after the revaluation model had been chosen and subsequently the active market ceases to exist, if the active market fades away, if the active market no longer exists, in that case that asset can no longer be carried at the fair value at the revaluation model, and it will have to be switched to the cost model. But its carrying value would become its cost from then onwards, and it would be accounted for as a normal cost model asset. Now, how to account for a revaluation? We will continue with the case when we purchase an asset for $100 and it had a useful life of 5 years. And since its purchase in year 0 till year 5, it was amortized down by $20 each year until its residual value remained nil. Now, what would happen if the same asset was carried at the revaluation model? So first of all, let's say that for the first 2 years it remained the same. The cost was $100, and for the first 2 years the annual amortization remained $20 in each year, and the asset dropped to the carrying value of $60. Now, if at the end of the second year the asset was revalued to $120, which means its carrying value was $60 and it has to be revalued to $120, which means it is a revaluation of $60. So far, the amortization which have been recorded in P&L was $40, and the accumulated depreciation in the balance sheet was $40. Now, because the assets have been increased to $120, the assets value would have to be increased. The best way to increase the asset value is to first remove all the depreciation, all the accumulated depreciation, and then increase the asset by the remaining amount. So we have a $60, which means we can wipe out the entire accumulated depreciation of $40, and then we can add further $40 to the assets account, which means we now have an asset standing at $120. The other effect of this revaluation would go into revaluation surplus via OCI, which means this increase of $60 on the debit side would be represented by the creation of an additional reserve on the credit side, and that would be of the equal amount, and that is $60. Now, these $60 reach this revaluation surplus via OCI and not via P&L. And what does this mean? This means that the profit or loss account should not be affected because of the revaluation. All of these revaluations should be presented separately in the other comprehensive income. Now that the asset has been revalued at the end of the second year to $120 and its remaining useful life is still 3 years, this means that we would have to amortize it by 120 over 3, which makes it $40 each year. So in the next year we would amortize it by $40. Now those $40 would be debited in the profit or loss account and credited in the accumulated depreciation account. But let me remind you that if the revaluation had not taken place, our amortization expense would have been only $20, which means the difference in this amortization is called incremental amortization, is due to the revaluation. So the standard says that we can actually transfer this amount from revaluation surplus to retained earnings to reverse the effect. But this is optional and it's not compulsory. If an entity has a policy to reverse this effect, then it would be this entry would be made, the revaluation surplus would be debited, and the retained earnings would be credited. But if that is not the policy of a company, then entity would not need to make this entry. Now we can compute the amortization expense for the 4th year, which would be exactly the same, $40, and the treatment would be exactly the same. The $40 would be debited in P&L, credited in accumulated depreciation account, and if the entity has a policy, the incremental amortization may be transferred from revaluation surplus to retained earnings. At the end of this year, the carrying value of the asset would be $40. Now, if the fair value of the asset at this point reduces to $10, which means it reduces by $30, what would be the effect? Now, here we have to also understand that what would have happened if no revaluation had initially taken place? What would have been the carrying value? Well, the carrying value at this stage would have been $20 at the end of the 4th year, which means this revaluation has two components. One is the $20, which have resulted in a decline in the revaluation surplus, and the other is $10, which is a decline below the historical carrying amount. And any movement below historical carrying amount is actually an impairment. And because it is a part of an impairment, this change would be reflected in the profit or loss account, and the change of remaining $20 would be reflected in the revaluation surplus. So as you can see that we cannot reduce revaluation surplus below zero. That is why once all of the revaluation surplus of that asset have been taken out of that account, we will not take out anymore, and all of the remaining effect would go through the profit or loss account.